Hello traders, welcome to ForexLia. Have you ever wished for a crystal ball? You know, something that could tell you exactly when a stock that's been soaring is about to take a nosedive. Some traders believe they have the next best thing. It's a tiny two candle pattern called the Bearish Doji star, and it can pack a serious punch. So let's break down what it is and how it actually works. I mean, that's the $1,000,000 question for any trader, right? How do you know when to get out? When's the top? It feels like you're just guessing half the time. But what if the charts themselves could give you a little heads up, a visual clue that maybe the party is about to be over? And this is actually where the bearish doji star come into play. You can think of it like a little flare pinning shot up from the price charts. It's a signal that all the upward momentum might just be running out of gas. It's a warning that a change of direction could be right around the corner. Okay, I get it. Bearish doji star sound pretty technical, maybe even a little intimidating. But here's the cool part. The name literally tells you everything you need to know about what it is and what it does. Every signal word is a clue. So let's decode these things piece by piece. Bearish doji star. We'll start with the most important one. First up, bearish. You know the old saying, bulls have horns that trust prices up. Will bears have clues that sweep price down? So right off the bat, bearish is our first use clue. We're on the lookout for a potential drop. Next we've got doji. It's a Japanese word and it's describe a candlestick where the price opened and closed at almost the exact same level. Picture a really instant tug of war between the buyers and the sellers, but at the end of the day, it's perfect T, that little cross or plus sign shape. That's a doji. It's a powerful visual sign of poor indecision in the market. And finally, start. This is all about its position. The doji caps up, meaning it's open higher than the previous candle closes. These little jumps create a visual gap, leaving that doji just kind of floating there by itself like a lonely star in the night sky, totally disconnected from everything that comes before it. Alright, so now that we decode the name, let's get down to business. What does this thing actually look like on a chart? How do you spot it in the wild? Here's the anatomy. First, you need a strong established uptrend, and at the top of the trend, you get a big long bullish candle. This shows that the buyers are confident they're in total control, but then something changes. The next candle gaps up, but it's just still out. It opens high but closes right back where it started, forming that classic doji star. It's this critical moment of hesitation right at the peak, a sign the buyers may be completely exhausted, and the scores material is really clear on this point. This isn't just a hint of a downturn. The claim is the once this pattern forms correctly, the possibility of that uptrend continuing is just over. That is a seriously bold statement about the shift in market psychology. Okay, so you've supported it. You see the pattern now, but you can't just stare at it. Let's talk about the playbook, how traders actually turn this signal into a potential action. Now, patience is absolutely crucial here. You don't just see the doji and immediately jump in. No, you have to wait for confirmation, and that confirmation comes from a third candle, one that closes below the low of the first big bullish candle. That is your green light. Only then do you consider your entry, and you always place a stop loss just above the high of the doji to protect yourself if you're wrong. But this raises a really important question. Does this pattern work the same on every single time frame? A 5-minute chart will, according to the scores material, not exactly. There's a pretty big difference. So here's the breakdown. For short-term intraday chart like your 5-minute or 15-minute charts, This pattern is said to work very well, but on the daily charts, it's a lot harder to say. And why is that? Well, it all comes down to volume. See, on a daily chart, you typically want to see a huge peak in volume to confirm a major reversal, but for the bearish doji star pattern itself, high volume ascent are required ingredient, which makes it a much better fit for the fast and furious world of intraday trading. Alright, let's work this all up with a super quick checklist. These are the non-negotiable rules you have to remember. Here it is, your cheat sheet. First, it has to appear after a strong uptrend. Second, that first candle needs to be long and bullish. Third, the second candle is that small doji that gaps up. And here's the golden rule, the one you can't forget. Always wait for confirmation from that third candle. And of course, protect your capital with a stop loss. That's the playbook. So there you have it, the bearish doji star. It's a pretty simple pattern that tells a really complex story about market psychology. That exact moment when confidence start to waver and a powerful trend might be about to turn on a dime. So now that you know how to read this little warning from the stars, the real question is, where are you going to spot it first? Now look at this chart. In this chart, after the bearish doji star pattern, the second candle itself closes below the low of the first candle. You have to see that until any signal appears on the chart that can change the market trend, you should not book profit. When you see any signal that can change the market trend, you should immediately book profit. So friends, today you have learned in detail about the bearish doji star. I hope you liked this information. Please like this video and subscribe ForexLia.